traders. When I used to play poker, when I used to really like games of chance and betting, the one thing that always fascinated me was the probability and the mathematics. Now, what I want to do today, and what we're going to do today, is we're going to apply the mathematics, the thinking of the games of chance, of how beating games of chance to options trading. Now, what I want to start this video off with is a little game. Now, if you were to play this game, would you take it? If I offered you this situation, first of all, do you want to play? Second of all, if you do play, what is your expected gain or expected loss, also known as expected value, for each dice roll? That's going to be a little bit tougher, but first see if you can answer the first question. I will reveal the answer in 5 seconds. Now, what we're going to be looking at today, and what we're looking at here for expected value, are you want to isolate two metrics: probability of success and the payout of success, probability of failure and the payout of failure. Now, what that means is really, if we roll a 1, 2, 3, or 4 on a 6-sided die, we know that there's about a 2/3 chance of doing that because there are four faces, and 4 out of 6, and 4 out of 6 is about 66%. Now, what we can do with that math is I can do the probability of success, which is 66% or 66.6%. I can do that times my payout. 66, or as a decimal, 0.66 times $10. Now, or actually, I'm going to do it this way. Perfect. Now we can do the same thing here. What is the probability of me failing? 0.33, 33%. Times, what's the payout if I do fail? 15. Now, why am I calculating all of this? What is the meaning of this? Well, this is going to tell me how much money I stand to make for each dice roll, or how much money I stand to lose for each dice roll. Meaning that if I did this thing 10 million times, then what would end up probably happening is I would probably get the expected gain times 10 million, or the expected loss times 10 million. Now, the answer here to this little math question would be 6.6 minus 5, 33% of 15, which is 1.6 per roll. Perfect. What we got here, from this little game, just saying, hey, do you want to take these odds? You've now just calculated your expected gain per roll. Meaning that if we did this game 1,000 times, you're going to probably make $1.6 thousand. You're probably going to make $1,600. Okay? And what I want to do with this is all fun and dandy. These are just betting games, games of chance that are, in a vacuum. But this can be applied to options markets. And let's take a deep dive back into options. Oops. Come on, come back. There you go. And what I want to use today are the July 5th options. And the kind of strategy that we're going to be looking at is a put spread. Now, guys, a put spread is when you buy a put with a higher strike and sell a put with a lower strike. And what you get from this is a kind of payout that looks like that. Now, with this put spread, these premiums that I got, I fetched from the order book here, the options order book here. Now, what I want to show you guys with this, and what we're going to be doing, is we're actually going to look at option strategies, and we're going to be able to see, does this have a plus EV? Is this a plus EV play? Or is this a minus EV play? Is our expected value in this option strategy high, or is it actually negative? Here is how you find that out. All right. First thing that I did, I inputted these. I inputted all the information here. Now, what you can do is scroll to the right when you have the options P&L. I'll link that in the description below. All the payouts for the gains are here, as you can see. Now, what I'm going to do is I'm going to shift-click, and I'm going to get all of the positive values. Why? Well, what I want to find out is what is the average gain when I win, and what is the average loss when I lose, within 12.5% of price fluctuation. If price goes 12.5% below or 12.5% above my break-even point, let me say that again. If price goes 12.5% that way or that way beyond my break-even point, what do I stand to gain average, and what do I stand to lose on average? So my average gain it's going to pop up right there, is 0.02755. All right, let's plug that into a little thing here. Awesome. Now I'm going to get rid of you. Now let's calculate average loss. My average loss here is this, 0.01222. So I'm going to just keep that guy there. Awesome. I'm going to keep that guy there. That's my average gain, and that's my average loss. Now we know the payouts here. This is the average loss payout, and this is the average gain payout. Great. But what we want to do here is apply probability. Let's first look at our break-even price, which is 12,340. Now what this means, guys, is if price, because this is a put spread, I'm betting on the market going down with fixed risk. If the market's below 12,340, I'm guaranteed profit. If the market settles below 12,040 in 9 days, I make money because these options expire in 9 days. Now, if price is above 12,340, I will lose money. Now, what we can do from that is go use a probability calculator. I'm going to list this in the description below. Now, what I can do is first type in the current Bitcoin price, which is 12,850, right? My target price is going to be my break-even point, 12,340. And we know that there are 9 days left in these options contracts, and we also know the percent annual volatility. Now you may wonder, whoa, where'd you get this number of 74? Well, to all you guys asking that, here you go. I'm using the Deribit historical volatility index, which is at 74.31. Just so we can be pinpoint accurate, let's go see. Let's put in 74.31, just cause. All right, here's the probabilities. What this is showing is there is a 36.4% estimated, guys, probability that price will settle below 12,340, which is our break-even point, after 9 days. However, there's a 63.5% chance of our loss with this strategy. Now, how do we apply this, to the actual numbers here? Well, remember we have the average payout and we have the average loss. So if we use that average payout, I can multiply my chance of success, which is 36.4%. So 0.364 times that. I'll put the minus sign here. It's gonna make it a little bit easier. And what's our chance of failure? Well, our chance of failure here, guys, is 0.635. Now, the number that's going to pop up is going to tell us if this has a positive or negative expected value. Well, let's see. You have a positive expected value. What we just calculated is that if you take this play, taking into account the probability and the payouts, you are expected over a period of time to make money. Meaning, if I took this play, guys, 10,000 times or 1,000 times, if I did this 1,000 times, I can show you guys that here, times 1,000. I mean, I would expect to make 2.27 Bitcoin from this trade over after 1,000 trades of it. If I took this 100 times, I would make 0.22, as you can see here. So we know that our expected gain, or expected value, is 0.00227, which at current market prices of this, times 12,800, which is current price, we know that would be around $29 for this in expected value. So what I just found is that this play that I just calculated is plus EV. This is plus expected value. Okay? Now, the one thing that I do want to say, if you do want to make these kinds of models for yourself, is you're going to want to put the current BTC price, not at the current actual BTC price, but at your break-even point. How do you find your break-even point? Well, you can do it the long way, which is like this. You see that 12,340 is not exactly, our break-even. I could do something like, hey, how about 12,337? What value does that give us? You can see that if you guys just noticed, 12,340 was where we were unprofitable. 12,337 was where we were profitable. So somewhere in between there is actually our literal break-even point. 12,338 is still profitable. 12,339, how about you? Oh, still profitable. 0.5. And it looks like that is actually our exact break-even point, is 12,339.5, meaning if price sells below that, we're making money. So why I do it this way is because then it centers the graph at your break-even point, and then it shows it 12.5% below and 12.5% above. Now, if you want to take into account, more market fluctuation, hey, let's do this for 25%. Let's just quickly do it again. Now, the average payout for 25%, let me get all those positive values here. And I am going to get the average there. I know that this is not perfect probability. Perfect, mathematics. This is just a very rudimentary model to give us, is this a good play? Guys, I'm not trying to be pinpoint specific here because I know that you could probably tell that this is not going to, it's not querying every single price. It's doing it like every $60, as you can see here. And that's not going to be perfect. So this is our average gain, 0.031, with the 25% market fluctuation. But basically, and then I'm going to take the average loss here too. But this is going to be able to tell us just how good really the play is. And we know now our average loss is this. And our probabilities are going to stay the same, as you can see here. Okay, that really changes it. Now that's interesting. So if price stays within, 12.5% fluctuation, 12.5%, price moves this way or that way, and settles between that within 9 days, then we stand to make about 0.0022 in expected value. However, if I take into account price could go down 25% or price could go up 25%, then I actually have a much higher expected value of about 0.00348. The reason for that is because my max loss is capped, as you can see here. Where is it? My max loss is capped, as you can see here. So the larger, if I put this to 75%, it's just gonna, your profit just, whoosh, but your loss is like that. But I typically like to just use 12.5% fluctuation because I think it's a little bit better. But of course, if you're looking at options that expire in 6 months, then you may actually just want to use something a little bit higher, like 50%. Seems like more fair if your options are expiring in that long amount of time. You do not just have to use call and put spreads, guys. You could use other kinds of trades too. Like we could look at a strangle. I could look at a strangle, which is where you buy a put, and if you go long strangle, you buy a put and buy a call with different strikes, but you buy a put at a lower strike than you buy the call. Or we can even look at something a little bit simpler that I wanted to go for, straddle, where you use the same exact strike prices. So if we were using, let's say a 13,000, and I'm going to get the options price for buying a call and buying a put at 13,000 of the July 5ths. Buying a call 13,000, I'm going to pay probably about 0.069. And that's that's very likely to fill if I do it at 0.069. So I'm paying 0.069. And I know that if I buy a put, that I'm going to pay 13,000, 0.075, or 0.075 I think is fair, or 0.0774. Okay. And we know that the current price, well, I'm just going to put this at 13,000. Perfect. And here she is. We actually have 2 break-even points, but I wanted to center it at 13,000, as you can see here. And where we would go from here is I would calculate what is my average loss and what is my average gain. Now to do that, all I would do is I would take all of the values from here to here. I would take them together. I could just show you guys, as well. I don't want this video to go on forever, but I do really love probability and looking at things like this. Average. Okay. So we know that the average here is 0.09. Okay, 0.09, and let's take the average gain for if the market does go up, because we have one for that as well. Okay, so those guys are here. Those guys are here. I know there's probably some Google Sheets or Excel person who's like, you're doing it the wrong way. You could do it so much easier this way. Yeah, I'm doing this definitely the very long way. So we know that our average gain our average gain for a call, yeah. So this is what you do to calculate your expected value for a strangle, for a long strangle, that is. Or even for a short strangle as well, you do the same thing. Now, this is average gain if price goes up. If price goes down, pardon me, if price goes up, our average gain is this. Hey, what's our loss? What's our average loss? Well, our average loss is going to be here. And perfect, we have all the numbers now. So our average loss apparently is 0.07. Jeez, that's kind of gnarly. That's not a great average loss. So we'll actually see if this play is even profitable in itself, if that's your average loss. But we'll see. Now the probability that price goes, let's see where our break-even point is here. The probability that price goes, I'd say break-evens at, I can get a little bit closer, even though I'm using 25%. What's our break-even at? 11,000. Estimated break-even point, I would think, is 11,350, 11,360, 11,360, I'm going to say. So what is the probability that price goes below 11,360? Yeah, perfect. And these values would all stay the same, of course. Probability that price goes below 11,360 is 14.15%, which is 0.145. So I know that, I'm going to do this. Probability that price does do that. Payout, average payout if price does do that, as you can see here. Now, what's the probability that price goes above that? Let's go find that out. Okay, so our break-even point here is, I think, clearly 15.2K, right? 15,190? That value's a little, yeah, 15,180, I think. So 15,180. 15,180, I mean, the probability of price being above that is 7.6%. So maybe this long strangle isn't looking, great. 0.076, because that's the probability of where is it? That's the probability of price going above there. Not great. Now, what's the probability that we lose money? Probably pretty high. Well, the probability that we lose money is going to be, it's actually given here, because there's a 92.3% chance. Well, first here I need to calculate if price is going to settle in between two values, which I don't know if this calculator can do, because what I would need to do is calculate what is the probability that price is going to be between 11,375 and 15,180. I think the probability for that is probably pretty high. But I could just do a quick spitball calculation, which would be to average the probability that price is below here with the probability that price is above here. Above here, below here. So we know that to do that, we know that the probability, where is it? The probability, I probably sound like a mad scientist right now. Probability payouts and all this. I love this stuff. It's really fun stuff. 0.923, and I know, what was my other value? This guy here, sweet. And probability of stock being above this is 0.854. So we know it's 0.923 plus 0.854 divided by 2, because that's the average probability of us losing money. Not the exact, because there's times where price can go below, price can go, above 11,360 and actually make us money. But this is just a very rudimentary, probability there, 0.8885. Or couldn't I? Okay, why didn't I think of that? You guys are probably yelling at me right now, as you should, because I could have just added this probability with that probability and then done 1 minus that. Why didn't I think of that? That's so simple. Wait, you just do 0.076 plus 0.145. I made this way harder than I should have, and then it's just 1 minus that. Done. 0.779. Done. Okay, that should not have taken that long. Then this is just 0.779 times that. Okay. Jeez. Okay, what's the expected value? It's horrible. Yeah, pretty bad. I think that my math is right here. I did the probability that price goes below. Yep, that one's right, and then that one should be right as well because it's just the opposite of these. So this is very, very, very bad expected value. Yeah, which means that taking this kind of long strangle is probably a not great idea unless you really think that within 9 days price can be above that or below that. But if we flip this on its head and said, hey, how about instead of taking a long strangle, we take a short strangle, we use something like this. Well, if you took a short strangle with these exact premiums, then you're looking pretty good. Because what that would mean, and I could just easily do, flip the numbers, negative minus that plus that. Because then the probability, then your expected value, if you took a short strangle with that strategy, your expected value is 0.038. All right, guys, I think that's got to be it for the end of this video. I did not expect to go that deep into... I was just going to talk about call spread or put spread and looking at the probability and looking at the expected value of each of those kinds of plays. But I also gave you ways that you can calculate probability for something like a long or short straddle, as you can see here. If you guys have any questions about, hey, how did you get that expected value? Hey, how did you figure out probability by using, this? Or, hey, how did you find average payouts, average payoffs if we succeed, average payoffs if we lose? How can this kind of formula be optimized or be improved? Because this is not perfection. This is very rudimentary. Is this a good play or not? But I really believe that this kind of strategy or this kind of mathematics can give you a really good idea for what options plays you probably want to take and which options plays you probably really don't want to take. Because we saw one options play that looked moderately good, and we saw one options play that looked pretty terrible with a long straddle. All right, guys. With that, happy trading, and if you want to learn any more or talk to me, you can join my Discord, which you can get by purchasing one of the guides in the description below. Happy trading.